Good morning, folks. Let's get down to it. Welcome to the Streets opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 11th of October, October 11th. Happy birthday, Cardi B. I know she is watching the show today. I'm JD Durkin. Opening bell rung just a moment ago here on the floor by Build-A-Bear Workshop, ticker symbol BBW, in celebration of Build-A-Bear's 25th anniversary. I don't know if you could see, but here on the floor, you will see lots of little Build-A-Bear stuffed animals in the next few minutes, I suspect. Quick check of the big board here, just a few moments into this trading Wednesday, see what investors have in store. A little bit of a pullback. The Dow right now is down about 0.3%. Again, that's the advantage of being on the floor. When I don't have the numbers in front of me on a computer, I pick my head up and I actually look at the real thing. It was already a busy week for investors, to say the least. Data on consumer sentiment, producer, and consumer price index figures all in the next coming days. And just as we were preparing to come on air this morning, breaking news from the IMF, which now predicts a significant slowdown in global growth in 2023, conditions that will feel like a recession for millions around the world. Quote, "The worst is yet to come," in the words of the IMF's report. We'll be breaking down what else we know there in just a moment. Again, that just breaking within the last hour. Also, Delta, Pepsi, Chase, Wells Fargo, and others will all report earnings sometime between now and your Saturday morning cartoons. Like I said, it's a busy week. On the show this morning, we take a closer look at what is moving markets as we get a sense of just how much red tape we may end up seeing between right now and the close of today, I should say. Plus, the Bank of England is intervening in the bond market, the latest move to calm markets overseas. We will break that down. And finally, just like your seats and your tray tables, American Airlines is up. We'll talk about what's moving the stock. For insights into all of those stories and so much more, we now bring in our senior editor and markets correspondent, the only man I want to talk to when no one knows what's happening, Martin Baccardax. Martin, good morning. I do want to first get your reaction here to the International Monetary Fund. They've called 2023 the weakest growth profile since the year 2001, outside of COVID and the crisis of 2008. The IMF given the warning the worst is yet to come for many people. 2023 will feel like a recession. Martin, I know in all fairness, this is not a story that broke a long time ago, but if there's any of it that you've been able to read into, I'm curious your reaction as we all just begin to see that news in the last few minutes.
Well, I thought, JD, that you summarized it quite well, in the sense that they're talking about the worst being yet to come, but at the same time, the reduction in their 2023 growth forecast wasn't that significant. They're taking it down, I think, to about 2.7%. Now, that's down from 2.9%, and it's certainly slower than the expectation for this year. But I think the broader context is the fact that the global economy is growing at around a 6% pace in 2021. So whilst the machinations of the change are not that significant, the downdraft from what we saw from the post-pandemic high is quite significant. And I think that's why the IMF is talking about what they see as economic conditions that will feel like a recession, even though we will probably see modest growth into next year. Now, a lot of that, of course, is going to depend on central bank reaction function. But interestingly, you're not hearing anything outside the Bank of England that would suggest that central banks are prepared to slow interest rate hikes into the teeth of this inflation surge. So we're at a really precarious point, I think, for growth here in the United States and indeed for the world as a result of that rapidly increasing inflation, the fact that supply chains remain disrupted, the fact that investment is being held at the sidelines whilst central banks increase their base borrowing costs, and as consumers pull back as a result of some very, very tepid, but nonetheless escalating weakness in labor markets, particularly here in the United States. So not only is the IMF sounding the alarm on growth, JD, but Jamie Dimon as well, during an interview with CNBC in London overnight, suggested that the U.S. could tip into recession in the next 6 to 9 months. And as a result, that could hive as much as 20% from the levels that we're seeing at the moment for the S&P 500. That wasn't a prediction from the JP Morgan CEO, but more of a worst case outcome if we were to have a hard landing for the biggest economy in the world.
All right, so let's go right there to the comments that Jamie Dimon made. He's warned the U.S. may dip into recession, like you just said there, Martin, sometime in the next 6 to 9 months. It's worth noting here, right? We've been talking about this for quite some time. Jamie Dimon is not alone. A recent KPMG survey of CEOs around the world showed that about 90% of CEOs think we're recession bound the next 12 months. Did we have a specific market reaction, you think, to Jamie Dimon yesterday?
Not particularly. I think what he said really echoes a lot of the data points that we've been witnessing over the last 4 to 6 months, particularly in the bond market, where we have seen rates on 2-year Treasury yields significantly higher than those on 10-year Treasury yields. And that kind of inversion has been typical of U.S. recession indications for a number of years now. So I don't suspect that we'll get anything completely.
We may have just lost Martin. We did lose Martin. Okay, that's Martin Baccardax. We're going to work to get his shot up. These comments here from Jamie Dimon were, of course, of incredible note here to CNBC yesterday. But like we said, Jamie Dimon is certainly not alone as a very notable CEO. He just tends to have a little bit of an outsized personality. When Jamie Dimon speaks, obviously the world is going to listen here. And we are going to get a bit more news on that IMF story as well. We're going to work to get Martin's shot back up. Interesting of note that Jamie Dimon continuing the criticism that we've heard from many people, many business leaders, many frustrated CEO, perhaps, of people in Jamie Dimon's position to say, you know, it's all well and good that the Fed is now engaging in good faith tightening, but they probably should have engaged in QT far sooner. It's a very popular argument, and when we work to get Martin back, look to see whether or not he feels that that is a fair criticism. Another thing we like to talk about with Martin is the overall vibe check, if you will, of the Fed. Martin very closely follows the CME Group Fed Watch, and we talked a little bit yesterday on the likelihood of another 75 basis point rate hike for the month in November. No shortage of things to discuss on a very busy Tuesday morning. We'll do a quick check in the market to see how investors are reacting here 7 minutes into the start of the trading session on this Tuesday. The S&P 500 has now dipped below that 3,600 level. Remember, that was the... Okay, absolutely. All right, so I'm just told that we're going to briefly put up a brief hold here while we work to... Oh, we've got Martin Baccardax back. See, Martin, when these things happen, my job is just to do a soft shoe routine and dance through it until we can get you. But like we said, no shortage of things to talk about. I just want to give you an opportunity to head back to the Jamie Dimon story and see if there was anything there, because I didn't want your important points to be cut off there.
No, the beauty of live streaming, something will go wrong, much like we're seeing in the U.S. economy at this point. But really, I think Mr. Dimon's comments were really echoing what we've been seeing in financial markets for a number of months now. We're seeing margin compression for S&P 500 companies. We're seeing this inverted yield curve where 2-year Treasury note yields are significantly higher than those of 10-year note yields, and that is one of the most accurate precursors of recession in the financial markets. We're seeing all sorts of indications that suggest a broader slowdown, apart from in the labor market. That's where I think we're seeing a bit of head scratching from economists, because of course we're adding about 250,000 new jobs each month. The unemployment rate fell to 3.5% last month, and wage growth, while not keeping up with inflation, is still reasonably robust. So it's interesting to me to see the resilience of the labor market set against what we expect in terms of weakness in the U.S. economy, which is still growing in the third quarter. It's not growing by too much, but just enough to probably avoid contraction. Now, ultimately, we will get the final arbitration on whether we slipped into recession this year, sometime in the middle of next year, as a result of kind of backward-looking the formulas and different things like that. But nonetheless, I think the broader weakness that we're seeing with most of our trading partners, and indeed in the global economy itself, as articulated by the IMF, does suggest that we're probably close to that tipping point of recession. And if the Federal Reserve is to maintain its rate hike path, take us to 4.5% on a Fed funds rate at the end of the year and hold that into next year, I think that most market participants would bet that we're looking at traction into the first 6 months of next year for sure.
Yeah, and I know that, like I said, that argument is not alone. That tends to be what the vast majority of people in this position talk about. And obviously, Jamie Dimon, like we said before we lost you there, Martin, is not alone with the vast majority of CEOs agreeing. If we're not already in a recessionary environment, we will be in the next 12 months. One thing, Martin, I want to get your perspective of is an argument that Jamie Dimon made. And he's also not alone here either. He says it's all well and good for the Fed to now be trying to tighten, but the Fed should have begun its QT process far earlier. Again, a popular argument. Is that a fair criticism? And I wonder, for people now playing Monday morning quarterback, or since we have Monday Night Football, Tuesday morning quarterback, to look back, when do they argue Jay Powell and his colleagues should have started this process?
Well, really, that's asking me how long is a piece of string, because I think there's going to be various answers of different proportion. But I think ultimately, when you look at the fact that US inflation was running close to 8% in the first 2 months of this year, and it wasn't until March that the Fed began its gentle rate increases, then you could argue that they were probably behind the inflationary curve, in large part because they were holding on to the anticipation that inflation would be transitory and that supply chain disruptions, once they receded, would create this arithmetic change in inflation calculations that would bring the rate down quite quickly into 2022. Now, we all know that that didn't materialize, and inflation actually accelerated further into the first half of the year. And that, of course, brought about the change in Fed policy and the faster and deeper than expected rate hikes. But I think the larger criticism with respect to unwinding the balance sheet is probably more valid. And by that, I mean, instead of bonds on the $9 trillion balance sheet earlier, which would have lifted market interest rates and provided a secondary form of tightening, was probably delayed a bit too long by the Fed. It only really began in June and hasn't really had a significant impact on markets until the past 3 or 4 weeks. That criticism is probably more valid than maybe some of the backward-looking criticism with respect to when and how quickly the Fed should have reacted with the blunt instrument of rate hikes.
Speaking of the blunt instrument of rate hikes, let's talk about that blunt instrument. You follow the CME Group FedWatch very closely. We discussed this yesterday. For people to get caught up and reminded, what is the likelihood that we're looking at another 75 basis point rate hike for the month of November? Let's talk blunt instrument.
Very high. Yeah, no, absolutely. It is very, very high. It's about 78% right now, 78.8 the last time I looked at it. In fact, it's paired a little bit from the high 80s and low 90s that we saw after the jobs figures last week, but it's still significant enough to suggest that the 75 basis points is baked in for the next meeting. I think ultimately now the discussion is going to be what happens in December. Do we stay with 75 or go with 50? In other words, do we take the Fed funds rate to 4.25 or 4.5%? Ultimately, my suspicion is that nominal level won't matter too much. What will matter more is how long the Fed stays at that elevated rate. So if they stay at 4.25% for 5 months, that's probably more damaging in terms of growth prospects than staying at 4.5% for 3 months. So ultimately, that I think is where the market focus is going to be in the coming weeks. But there's no question about it. The Fed isn't prepared to blink, and markets are really only coming to terms with that over the past 3 or 4 weeks, which to me seems rather astonishing. But nonetheless, that's where we are.
Martin, with an eye to the next few days for investors that are tuning in and saying there's so many important data points, you got the consumer price index, producer price index, consumer sentiment from University of Michigan. This might be an impossible question, but for someone watching the broadcast this morning saying, just give me one new data point that's going to come out this week that perhaps is most important, what should I follow? What would you tell that investor who might otherwise be a little overwhelmed with all of the flurry of news and data points we're expecting in the next week or so?
Yeah, picking one is tough, JD, but I'm going to stick with my prediction that the September retail sales figures are going to wind up being the most important data point that we get this week, because I really do think that the American consumer is going to be, the leading component of the economy's ability to avoid recession, or indeed to make that recession as shallow as possible. But they are running down their pandemic era savings, and we are seeing some weakness in the labor market, and that, of course, combines to create a bit of uncertainty with respect to consumer spending. So I'm really looking at that number probably more than I am the inflation number, although there's no question that's going to be extremely important, because at the end of the day, this is a consumer-led economy. 2/3 of growth is driven by consumer spending and services activity. So that number that we'll get on Friday, I think, is going to be incredibly important.
Let's move on here, Martin, because this is really important, I think, for people who are waking up right now to news of market dysfunction overseas. The Bank of England is warning the financial crisis has not gone away. What are they doing now, Martin?
This is a really complicated story, but I'm going to try to simplify it as best as I can, JD. Essentially, what's happened is a couple of weeks ago, the government proposed some new budget suggestions that they said was going to entice growth in what has to be remembered is the fifth biggest economy in the world. What they said was they were going to cut taxes at the highest level for those earning the most, and they were going to increase borrowing, not only to fund the lost revenue from the tax cuts, but to also make sure that they can pay for the energy price cap that they plan to put in place for the winter months as a result of the surge that we've seen in oil and gas prices. Now, markets were unsettled by that, particularly as a result of the anticipated increase in borrowing, which was going to be somewhere in the region of 80 to 100 billion US dollars. So bond yields shot up. Now, bond yields move inversely to prices. So as they rise, prices decline. What we saw with the pension fund industry in Britain was that the decline in those bond prices actually accelerated demands for deeper capital commitments in order to offset the decline in those prices. And that created a bit of a downward spiral. The more they sold, the more yields rose, and the more capital was required to benchmark or to sort of offset the price declines, kind of what some people have described as a doom loop. Now, that is extremely unsettling for financial stability, and as a result, the Bank of England was forced to go into the market last week, purchase government bonds in order to stabilize yields and stop that doom loop and allow pension funds to get out of what's called a liability-driven investment strategy. Now, LDI, as it's called, is actually quite a sensible way for pension funds to manage the risk. Essentially, what they do is they look 30 or 40 years down the road, find out what liabilities they expect to pay to their members, and then hedge against it with assets that have a similar maturity. But as I just described, when those asset prices fall as a result of rising yields, they have to put more capital against it. So the Bank of England went into the market last week, bought about 65 billion worth of bonds. They came into the market again today, and they were buying inflation-linked securities as a result of the dysfunction that they described last week and saw again on Monday. Now, some have criticized the bank's activities given the fact that they were planning to sell government bonds as part of their quantitative tightening, which we just talked about in context of the Fed, as a result of their rate hikes and their attempt to tame inflation, which is accelerating at double digits in Britain. But what they're having to do now is stabilize financial market conditions as a result of this government policy, which the government itself seems to be backing away from. But the dislocation it's caused in pension funds is rippling through to assets all around the world and is having impacts on US Treasury bond yields and indeed other stock and bond assets that are held by these British pension funds, which is a really significant part of the global industry. So the bank's attempt to stabilize this has only been partly successful, and the anticipation is they're going to have to do this even more frequently going forward, and that is going to slow their ability to fight inflation, and that will probably add to further weakness for the British pound, further dislocation in financial markets in Europe, and probably as a result, weaker than expected growth for what is still a very important economy in Europe, despite the Brexit decision from a few years ago.
Martin, I'm going to be honest, my friend. I wish that I and I alone could bestow on you a Nobel Prize for economics, a Nobel Prize for anything, honestly, given the professionalism with which you handled that incredibly difficult answer, completely off the dome, as we say. Rap fans, off the dome, just spit a freestyle there. That was very impressive, and thank you for that. Now,
Spit a freestyle, exactly.
It's a freestyle. Now, there's a phrase you heard that I think a lot of our viewers may have latched onto the last few years with regards to quantitative easing in part, and that's the idea of government buying bonds. So you just talked about there with regards to the Bank of England. It's obviously been front and center for people here in the U.S. What should we know about the relationship between what's happening there and what's happening here, either now or in the future? Are any of these things potentially predictive indicators of what's to come here stateside, or is a lot of this dysfunction, you think, pretty relative to being overseas?
I think for the most part, it's a UK-centric situation, but it can't be denied that that what we have seen as a result of central bank activities in the bond market has created kind of a price dislocation. And by that, I mean, JD, previously, certainly in another incarnation of financial markets when I was much younger, the bond markets were seen as the canary in the coal mine with respect to economic conditions, with respect to financial stability concerns and all those other things. They would bubble up in the bond market first, and then they would be felt and rippled through in terms of impact into the stock market. Because central banks have been buying such a significant amount of bonds over the past 10 years as a result of in the wake of the global financial crisis, price discovery has become much more difficult. And as a result, investors aren't as confident about the warning signals that they get from the bond market as they used to be in the past. And that's something that has created some of the market volatility that we've witnessed over the past years, because we simply don't have the warning signs with the same degree of confidence that we used to have. At the moment, however, what we're seeing in the US is the Fed is no longer buying bonds in order to suppress market interest rates. What they're trying to do is sell bonds into the marketplace and raise them at the same time that they're raising benchmark borrowing rates through their Fed rate hikes. That twin impact is likely to have a more significant result in terms of policy tightening than simply raising rates alone. But again, it adds further disruption to a really important, and it must be remembered, the largest financial market in the world. And that, of course, is something that stock investors and everyone else needs to understand, because, again, the warning signals just aren't relayed with the same degree of confidence as they used to be, whether the Fed is purchasing bonds or selling them. And we may end up in that kind of condition for many years to come, because the Fed's balance sheet is somewhere in the region of 6 to 8 trillion, and it's going to take a long time to unwind that.
Martin, you and I could talk markets and the underlying conditions here all day. There are a bit more specific lanes that I do want to touch on with you before we wrap up the show today. And,
Sure.
and Bank of America, I heard this morning, say what we already know, which is that Americans are traveling. We're spending a lot of money on travel right now. And it's not just trips that Americans booked months ago that they're going on now. But I heard Bank of America say this morning that there's evidence that even now credit card purchases are being used specifically for air travel for future trips, even despite other inflationary pressures, which leads me to American Airlines specifically. What do we learn from AA, and how are investors reacting so far here today?
They really seem to like what they heard from American Airlines this morning, JD. They're going to give us third quarter earnings next week, but they had an update this morning that suggested their revenue forecasts were probably a little bit tame in terms of the anticipated gain. So they boosted their third quarter revenue forecast, and they see it growing by about 13% from 2019 levels. Now, that 2019 level figure is incredibly important, because that was, of course, pre-pandemic, when travel was roaring at near record highs. We've actually seen the result of pent-up demand over the pandemic period boosting airline stocks, or at least airline travel for most of the year. Indeed, over the Labor Day holiday in September, JD, we had a record amount of passengers screened in U.S. airports based on TSA data. So Bank of America is absolutely correct in seeing that kind of trend, and the escalating trend of people booking experiences over, let's say, goods and other services. That seems to be the trend, particularly for younger Americans in this economy. So American is seeing that development too. And at the same time, what they're seeing, it seems to me, is improving profit margins. Jet fuel prices are falling as a result of the decline that we saw over the summertime in global oil prices. And they are able to they're able to increase prices per seat to a level that Americans aren't simply willing to sort of pull back from. In other words, American has, and all the other carriers have, decent pricing power to meet this pent-up travel demand. So that's improving profit margins, it's improving revenues, even if capacity is running below 2019 levels. And by that I mean, JD, there are fewer planes flying, but they're much more full than they were back in 2019. That's giving greater revenue growth, it's improving margins, and it's probably going to increase the potential for profitability, if not in the third quarter, certainly going into the final months of the year.
A rising tide lifts all boats, Martin, or in this case, maybe all planes. We'll be hearing from Delta on Thursday. Can we expect a similar bounce back in revenue, you think, for a lot of the other giants in the sky?
Yes, I think so. I don't think anybody's going to be left out of this pent-up demand drive. I think what will ultimately be important to see is whether or not the carriers are going to increase capacity as a result. There was some criticism over the summer for them not doing so, particularly when there were so many cancellations as a result of labor shortages. Most of these carriers still need more pilots, they still need more ground crew, and they still need more people in the cabins themselves, serving this increase in customer demand. And they just haven't been able to meet it for a whole host of reasons that are probably not unique to the airline space in this tight labor market. So I'm going to be looking at whether or not they are going to increase capacity and as a result be able to improve even further their potential profitability. But they may feel that they're not quite ready to do that just yet until they can meet the expectations of incoming labor, and they're not quite there just yet. So I would imagine the capacity will be, if not the same, only marginally better, and the profit margins will be more important for investors going forward.
With what minutes we have left, time out for our rapid fire section.
Let's do
First
it.
up here, Martin, I want to get your take on this. What is going on with chip stocks? What's up with that?
This is an interesting one. Last week, the Biden administration unveiled some sweeping changes in terms of how and when and to what degree U.S. tech companies can export some of their chip-making tools to China-based customers. Essentially, the Biden administration wants to be sure that China isn't using American technology and innovation to boost its military and to use some of that technology, maybe even to survey or to surveil U.S. companies and U.S. citizens as a result. Now, that's had a rippling impact across the chip sector because many of them rely on China-based customers for a significant portion of the revenue. And furthermore, GD, just because companies are holding back investment as a result of the uncertainty that they see in the broader economy, we're anticipating lower sales for PCs, for smartphones, for cloud computing chips, and all these other things, all these other components that the companies have relied on over the past months. So analysts are downgrading the stock as a result, and they're getting hit by both the economic uncertainty and the anticipated recession, as well as the sweeping export restrictions that were unveiled by the Biden administration last week.
All right, let's talk gas prices here for number 2 in our rapid fire section. Is more help on the way at the pump?
We're looking at certainly softer oil prices in overnight trading, JD, and I think ultimately that's linked to the fact that China, which is the biggest energy importer in the world, has just returned from its week-long holiday, which it celebrates each and every October. And as a result of people traveling, going back to family and friends and things like that, they've had a spike in COVID infection. So they're actually accelerating the testing procedures in Shanghai and Beijing and other large cities, and that is creating concern that their zero COVID policy is going to incur lockdowns in the coming weeks and therefore slow further industrial activity in the world's biggest exporter and indeed the world's biggest energy market. So oil prices are off. They're not off to the degree that we saw prior to last week's OPEC decision to cut output as a result of the pressure that was put on one of their member allies, and that, of course, being Russia. So the fact that OPEC cut their output added upward pressure to U.S. gas prices. They've been rising for about 3 weeks now, and they're around $3.92 a gallon across the United States. But if China is going to hold to the zero COVID policy and the global economy is going to slow to the anticipated rate that we're seeing from the IMF and others, you can imagine oil prices will fall in concert, and the rising U.S. dollar will probably mean the better cash prices heading into November and December, probably not significantly different than what we're seeing right now. I would imagine we're probably going to level out at around the 350 mark heading into the end of the year.
All right, number 3 in our rapid fire section, Amazon Prime Early Access event. Very excited. I got notifications on my phone for it early this morning. Has holiday shopping officially started? Oh, goodness. On October 11th, Martin.
I felt like we were seeing Christmas decorations in August, JD. It's a strange one this year. I ultimately don't think this is a good thing, and I'll try to explain why. I think we're seeing a lot of retailers, Amazon being one of them, Walmart, Target, Kohl's, and others, bringing forward their holiday discount efforts, I think, in order to capture the final bit of pandemic-era savings that American consumers are holding on to. I don't think the fact that they're bringing this into early October is a sign that they are confident that the U.S. consumer is going to be in a spending mood in late November and early December and then want to capture it as early as possible. A study from Deloitte a few weeks ago suggests that the whole of the holiday season shopping spend is going to rise about 6% from last year's levels. That's more than 50% down from the levels of advance that we saw in 2021. It's still going to mean about $1.5 trillion in spending from October until the end of December, but it's not quite the level that we saw last year. And I think that slowdown might be even more significant if some of the conditions that we've been talking about in the broader economy play themselves out over the coming months. So I think Amazon, Target, and others bringing those forward into early October is more of a sign of concern as opposed to optimism. And that's probably why I'm so focused on the retail sales numbers that are coming later this week.
I know you're also focused on other things like our number 4 story in our rapid fire. Also the reason I did not sleep a lot last night. Kansas City Chiefs over the Vegas Raiders. What did we learn on Monday Night Football? It goes so late at night. Martin, what did we learn?
Well, firstly, you're absolutely right. I have no idea why these games kick off at such a late hour. We're all sleep deprived, and the NFL is just playing us like fools as a result. But we talked about this yesterday, JD. If you do not have a quarterback, you simply do not have a chance. And yesterday, what we saw, of course, from Patrick Mahomes was just another classic performance. At one point in the game, they scored 5 on 5 consecutive possessions, and their tight end, Travis Kelce, had the best night in a primetime game since Randy Moss in 2007, which I think is just absolutely spectacular. So, again, talent rises to the top, and the elite quarterbacks in this league are just such exceptional athletes that even being down 17-0 against a very good Las Vegas Raiders teams doesn't really mean too much to a guy who's able to drive his team to score in 5 consecutive possessions. So I thought that was just a fantastic performance and indicative of what we're seeing across the league this year. And that, once again, because of the rule changes and what the NFL wants in terms of star power, it's a quarterback-driven league, and it's going to remain so for as long as you and I are watching, I'm sure.
Travis Kelce had, it was kind of a bizarre stat line, right? 25 yards for 4 touchdowns, right? That's not usually the stat line you see, but that does show you just how potent that red zone offense was. And it's like every single person in that stadium knows that Travis Kelce is going to get the football thrown his way.
Yeah.
And 4 different times it happened. It was a really great game, though, and I think it's funny. We started this weekend with not a great game on Thursday night, and then we ended with a must-watch, point away, in your seats. You know, Vegas could have tied it, but shoulda, woulda, coulda. Okay, the great Martin Baccardax. You know, this is so fun, my man. We get to do this. We hit on so many topics, the important stuff, and have a bit of fun as well. Martin, thanks a lot, and we get to do it again tomorrow. Enjoy your day, Martin. Thank you.
Good stuff. Thanks, JD.
You got it. All right, that's going to do it for the Market Open here from the floor of the NYSE. Stick with the street for more on these and all of the other major market stories that matter to you. We'll see you tomorrow.